Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section E. This is an application topic. Determine the pressures, incentives, and opportunities for fraud, and that would be for fraudulent financial reporting and misappropriation of assets that could lead to the risk of material misstatement. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is only 1 hour, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. After you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. In today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members get access to the full versions of these videos. So in this case, it would be a 10-question video so that they can get a little bit more understanding and a little bit more help. So again, if you like this, make sure you check out becoming a SuperfastCPA Pro member so that you can get access to the full 10-question versions of these YouTube videos. Now with all that, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Which of the following would not raise concerns about fraudulent financial reporting? Okay, let's go through the options. Option A, an overly complex organizational structure with unusual related party transactions. Option B, earnings growth that is not supported by a corresponding increase in cash flow. Option C, management's strong interest in increasing the company's stock price and reported earnings. Or option D, a professional yet distant relationship between management and the previous auditor. Okay, so which one of these is something that's not going to raise concerns about fraudulent financial reporting? Now, if you don't really know what the concerns would be when it comes to fraudulent financial reporting, that's okay. We're going to learn about that in this video, and we're going to learn about the fraud risk factors. But again, if you don't know, that's okay. We're using these questions to learn. So let's go ahead and look at the explanation to learn what we need to know. Okay, here we are at the answer D. A professional yet distant relationship between management and the previous auditor would be something that is not a concern necessarily for fraudulent financial reporting. So let's go through the explanation. Fraud, and this is just the basic explanation of it, involves intentional deception to achieve an unfair or unlawful gain. That's just the basic idea behind fraud. In financial reporting, fraud typically occurs when management manipulates financial statements to mislead investors, regulators, or other stakeholders. Fraudulent financial reporting can arise from pressures to meet earnings targets, opportunities to manipulate numbers, and rationalizations by management. Red flags include an overly complex structure that obscures financial dealings. That was option A. Earnings growth that does not align with cash flow. That was option B, and I kind of want to talk about that one a little bit more. Basically, the idea behind that one is if a company is having earnings and their earnings are going up and things are looking good, but then you look at their cash flow and they don't have an increase in cash flow and actually things are looking bad there or something like that, that would be a red flag because, they're saying they have earnings, but they don't have the cash to back it. That's a little bit unnerving. Now let's talk about the next thing. And management's excessive focus on stock price is again another thing that would be a factor that would make you kind of more concerned. However, while a strained relationship with a previous auditor may be concerning, a professional yet distant relationship, which was option D, is not necessarily a red flag and does not on its own indicate a heightened fraud risk. So all of these could be or are things that would make the auditor have a heightened concern for fraud. But option D isn't necessarily going to be one because if they just have a professional but distant relationship, that's okay. But if it was a strained relationship where they don't get along, something bad happened, and that's why they don't have the previous auditor, that would be something that you would want to look into. Those are some of the factors that would cause you to be more concerned about fraudulent financial reporting. Now let's go to the next question. All right, here we are at question 2. Which of the following situations would most likely raise an auditor's concern about the risk of misappropriation of assets? Okay, let's go through the options. Option A, the company has a large amount of cash and other liquid assets on hand with minimal oversight. Option B, the company requires dual authorization for all significant disbursements and regularly reconciles accounts. Option C, the company's inventory consists primarily of specialized machinery that is difficult to resell. And option D, the company conducts independent reviews of financial transactions and employee activities on a routine basis. So again, which one of these would most likely raise an auditor's concern about the risk of misappropriation of assets? Again, if you don't really know what misappropriation of assets is, that's okay. We're going to use this question to learn about it. But if you have an idea, pause the video, think through this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer A. The company has a large amount of cash and other liquid assets on hand with minimal oversight. So that would be a big red flag for misappropriation of assets. Let's go through this explanation. Misappropriation of assets is a type of fraud where employees or others steal company resources for personal gain. So they're not lying about things on the financial statements necessarily. They are just stealing the assets of the company. It often involves cash theft, fraudulent disbursements, or misusing company property. Now, there are 2 key factors that you probably need to know that would increase the risk of misappropriation. First is lack of independent checks. Now, what does that mean? I honestly didn't know what that meant when I was going through this, so I wanted to explain it really well. This means there is little or no oversight from individuals not involved in day-to-day transactions. Without independent reviews or separation of duties, fraudulent activity can go undetected. So basically, if there's no oversight and there's no separation of duties and things like that to make sure that employees are doing what they're supposed to be doing, that is a huge factor in there being misappropriation of assets. The next one is large amounts of liquid assets. Cash and assets that can be easily converted to cash, such as inventory or receivables, are prime targets for theft because the employee or whoever is stealing can steal it and immediately either just have cash because they stole cash, or they can immediately sell it and get cash. Highly liquid assets are things that are going to be targeted when it comes to misappropriation of assets. Option A highlights both risk factors, large liquid assets and minimal oversight. In contrast, options B and D describe strong controls that reduce fraud risk, and option C involves specialized machinery, which is harder to steal and resell. So again, the idea that you're going to want to be looking for when it comes to misappropriation of assets is you want to look for where the controls are not doing well, where they're not separating things the way they should, and where there's liquid assets that can be easily taken and either they just have the cash or they can sell those liquid assets for cash really easily and really quickly. Those are the things that are going to be stolen most likely. Now with that, we learned about fraud when it comes to misappropriation of assets. Now let's go to the next question. Okay, here we are at question 3. Which of the following situations would most likely create pressure or incentive for fraudulent financial reporting? Okay, so this is something a little bit new. Let's go through these options. Option A, a company's revenue has slowed and management is concerned about future growth. Option B, a publicly traded company is at risk of missing analysts' earnings expectations by a small margin. Option C, a company's board has encouraged cost-cutting measures to improve profitability. Or option D, a private company is considering going public within the next few years. So again, which one of these is most likely going to cause pressure or create an incentive for somebody to do fraudulent financial reporting? Now, I think you can understand the word pressure or incentive. So pause the video, think about this. Which one of these is going to cause the greatest pressure or the greatest incentive for somebody to fraudulently change the financial reporting? Pause the video, think through this, and when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is B. A publicly traded company is at risk of missing analysts' earnings expectations by a small margin. So this would be the most likely thing to cause somebody pressure or give them an incentive to commit fraud. So let's go through the explanation. Fraudulent financial reporting is often driven by pressures or incentives that push management to manipulate financial statements. One of the most significant pressures comes from external expectations, such as meeting analysts' earnings forecasts. A publicly traded company that is close to missing expectations, and that was option B, faces strong incentives to manipulate revenue, expenses, or reserves to avoid stock price declines and investor backlash. So, I think that makes sense. When there is pressure or an incentive for the company to lie about their numbers so that they can keep their stock prices or things like that, that is something that is obviously going to make them more likely to commit fraud. The other options represent potential pressures but are less immediate. Slowing revenue, that was option A, is concerning, but does not necessarily demand immediate fraudulent action. It's not necessarily going to lead to fraud. Cost-cutting efforts, that was option C, may create internal pressure, but do not directly relate to financial reporting fraud. And planning for a future IPO, and that was option D, may increase the desire to present strong financials, but lacks the urgent short-term pressure that could drive fraud. And again, because that one was in a few years, you want to be thinking about things that this is about to happen. We need to commit fraud right now, or else our company is not going to do well, or whatever the case is. Those are the kind of the pressures or incentives that you're probably going to be seeing in the exam. Now with that, let's go to the next question. Okay, here we are at question 4. Which of the following situations would most likely create an opportunity for fraudulent financial reporting? So let's go through this. Option A, a company has complex financial transactions that require significant judgment in applying accounting standards. Option B, a company's internal audit function reports directly to senior management rather than the board of directors. Option C, a company's management has override authority over key financial controls with little independent oversight. Or option D, a company operates in a highly regulated industry with frequent external audits and compliance reviews. Now, if I'm being totally honest, I think that if you read through this, or if you were, listening to me read through those, that you probably know the answer already. But if you don't, that's okay. Pause the video, think through this, and when you're ready, come back. We'll look at the answer together and learn a little bit more about opportunity when it comes to fraud. Okay, here we are. The answer is C. A company's management has override authority over key financial controls with little independent oversight. Now, again, I feel like that one was probably pretty obvious, but let's go through the explanation to learn more about opportunity. Fraudulent financial reporting requires opportunity, which arises when poor internal controls allow individuals to manipulate financial statements without detection. Management typically has the greatest opportunity to commit fraud because they have authority over financial reporting and internal controls. So basically, the idea behind opportunity is the company doesn't have the correct controls in place, so that creates opportunities for people to commit fraud. Now, management is a problem here because they can still, a lot of times, even if there are the correct controls, still go over the controls and override them, and they can still commit fraud in that way. Management override of controls, and that was option C, is a major red flag because it allows executives to bypass safeguards and manipulate financial results without being detected. And this is something that is really hard to avoid. You can't completely 100% rule this out. It is something that is almost always going to be there as a threat. Now let's talk about why the other options were not necessarily as important when it comes to opportunity. Complex financial transactions, and that was option A, may create room for accounting errors or aggressive estimates, but complexity alone does not provide an opportunity for fraud unless controls are weak. And again, we go back to controls there. Internal audit reporting to senior management, and that was option B, could limit independence, but the real risk is when there is no oversight from the board or audit committee. And operating in a highly regulated industry, that was option D, typically reduces fraud opportunities because external oversight and audits increase the likelihood of detection. So that one was obviously not the correct answer because it actually would make it less likely that there are opportunities for fraud. Strong controls, independent oversight, and regular monitoring help reduce fraud opportunities, making management override, and that was option C again, the most concerning risk. And again, it's kind of hard to avoid that one. It's kind of an inherent risk about companies and about auditing, but that's the way it is. Now with that, let's go to the next question. Okay, here we are at question 5. Now, something we haven't really gotten to do yet because most of the other questions were too small to do this, but this is something I always like to point out. If you see a kind of a bigger question with multiple paragraphs or even just a big paragraph, you want to read the last part of the question first. The reason you want to do this is because this will give you context for what the question is asking, because usually the last sentence is what the question is actually asking. Not 100% of the time, but very frequently. And this is a great strategy for test day so that you can quickly understand what you're supposed to be doing in the question and then read through the rest of it. And that will help you move through questions more quickly on test day. So let's do that here. First, which fraud factor is being demonstrated by Lisa in this situation? So again, imagine you were on test day. You read that last sentence and you immediately know you're dealing with fraud factors. So that is something that you want to be thinking about throughout the rest of the question. And that will help you to be more quick and efficient with the question. Now let's go up to the top. Lisa, the controller at Horizon Tech, has been with the company for over 15 years and is well respected by management. Recently, the company has been struggling financially, and executives have hinted that layoffs may be coming if performance doesn't improve. To help the company, Lisa decides to recognize revenue early on a few large contracts that were signed but not yet fulfilled. She tells herself, I'm not stealing anything. This is just helping the company get through a rough patch. Once business picks up, everything will even out. So again, which fraud factor is being demonstrated by Lisa in this situation? So think about this. I think that it will be pretty obvious which one it is, but if you need to, pause the video, think through this, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is C, rationalization. So let's go through this explanation. Rationalization occurs when an individual justifies fraudulent behavior, convincing themselves that their actions are acceptable. In this scenario, Lisa rationalizes, recognizing revenue early by believing she is helping the company and that the situation will correct itself in the future. Pressure, and that was option A, exists due to the company's financial struggles, but Lisa's reasoning is what allows her to act. And, obviously, anytime there's rationalization, almost always connected with it, there's going to also be pressure and opportunity. So, of course, you technically could have picked those, but the reason that it says demonstrated by Lisa in this situation is what is Lisa doing? What fraud factor is Lisa committing herself? Because the pressure is not coming from Lisa. And the opportunity technically isn't really coming from Lisa either because she was put into that management position by the company. And the weak internal controls are allowing her to do it. Now, again, I'm not saying that Lisa isn't at fault for the opportunity or succumbing to the pressure. But again, the thing that she is 100% responsible for is the rationalization. So rationalization is the thing that makes the most sense. But again, pressure is there. Opportunity, and that was option B, is also present since Lisa, as the controller, has the ability to adjust financial records. And then financial distress, that was option D, is a condition affecting the company, but is not a fraud factor itself. There are 3 fraud factors, and we've talked about all of them now: rationalization, opportunity, and pressure or incentive. What ultimately enables the fraud is Lisa's belief that it is justified making rationalization the correct answer. Again, there is pressure, there is opportunity, but what is Lisa doing? She is rationalizing the fraud. Now with that, we've learned a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions, you will notice the things that keep popping up. You see 2 or 3 or 4 questions trying to teach you about opportunity in different situations, or trying to teach you about rationalization in different situations. Whatever the case is, you notice these things popping up in the questions. So you take a moment and write these most important things that you learned in your own words. And as you're doing this each day, you're building your own personal repository of the most important things you need to know for the exam, again, written in your own words. Now with that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, fraudulent financial reporting. Fraudulent financial reporting occurs when financial statements are intentionally misstated to mislead stakeholders. This often involves inflating revenue, concealing expenses, or manipulating estimates to meet earnings targets or financial expectations. Management is typically in the best position to commit this type of fraud due to their control over financial reporting. Now let's talk about misappropriation of assets. Misappropriation of assets involves the theft or misuse of a company's resources, such as cash, inventory, or supplies. This type of fraud is often committed by employees and is more likely when valuable assets are poorly controlled and oversight is weak. Now let's talk about the 3 fraud factors. You might have heard of the fraud triangle. That's what these 3 things are. First, let's talk about pressures and incentives. Pressures or incentives for fraud arise when individuals feel financial or professional strain, such as meeting earnings targets, avoiding debt covenant violations, or securing bonuses. These pressures increase the likelihood of fraudulent behavior. And let's talk about opportunity now. Opportunity for fraud exists when weak internal controls allow individuals to manipulate financial records or steal assets without detection. Management has the greatest opportunity to commit fraud, especially if they can override controls or lack independent oversight. And then finally, rationalization. Rationalization occurs when individuals justify fraudulent actions, convincing themselves that their behavior is acceptable or necessary. Common rationalizations include believing the fraud is temporary, harmless, or done for the greater good. So again, those are the 3 things that are going to always be present when there's fraud. There's going to be pressures or incentives, there's going to be an opportunity, and then there's going to be rationalization, because even if there's pressures and incentives and opportunity, if the person doesn't succumb to rationalizing the fraud, then they're not going to do it. So all 3 of the things have to be present. Now with that, we've learned a lot about the fraud risk factors, or again, the fraud triangle, when it comes to fraudulent financial reporting and misappropriation of assets. And that is the end of the YouTube video. Remember, we only went over 5 questions in this video, but SuperfastCPA Pro members are going to get access to the full 10-question version of the video that I'm about to finish recording after this. So if you like this and you like our other videos, become a SuperfastCPA Pro member and you'll get access to a lot of great stuff, including, again, the full versions of these videos so that you can get a little bit more help and a little bit more understanding. The easiest way to become a Pro member, by the way, is by checking out our SuperfastCPA training webinar on SuperfastCPA.com. Sign up for that 1-hour webinar. We will teach you the key ingredients to passing the CPA exam. And again, that will give you the best path to becoming a Pro member. So make sure you check that out as well. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.